Okay, so with that, we just wanted to start off by just walking through some of the fundamentals just to make sure we all level set, to make sure that we all understand exactly what we're talking about. There's a lot of confusion into what blockchain actually is. A lot of people confuse it with cryptocurrency, which is a huge mistake. There's a difference between security and utility tokens. There's a whole host of things that I want to make sure we collectively understand so we can have a more informed conversation. So with that, Josh, why don't you and I just walk through some of these initial slides. I love this analogy, and you talk about it often. So I'd like to start by you just essentially walking us through holistically how you view the blockchain and how you view it as revolutionizing the real estate industry.
Sure. So as it goes, people talk about security tokens or tokenizing securities. It's talking about taking today private securities, a security interest that exists only on paper, a share in an LLC, an LP interest in a fund, a share in a private REIT. All that private capital formation that today exceeds public raises is all paper-based. You cannot electronically trade it. The whole idea of tokenization is that you put an electronic wrapper around it, and if you put the right infrastructure in place, you can trade that share as easily as sending an email. You can take the liquidity of the public markets and bring it to private placements, which is transformational. And the best analogy I can give you is email and snail mail. Both of them are written communications. It used to be we typed out a written communication, we pressed print, put an envelope, we paid 50 cents, we waited a few days. Then later we could spend 30 bucks and send it overnight. And then eventually we click send, and it's faster, cheaper, and easier by orders of magnitude. And it revolutionized how we communicate in a written format. Content of the communication is the same, but suddenly we send and receive far more emails than we ever did letters. And you use emails in situations in which it was never practicable to send a letter. In the history of the world, no one ever sent a letter to their cubicle mate saying, where are we grabbing lunch? But we do that all the time with email. And similarly, when we take this electronic wrapper, you can call it a token, you can call it crypto. All it is take an electronic wrapper around that private security, and it's faster, cheaper, and easier to raise the capital and issue the security. But more importantly, it's faster, cheaper, and easier by orders of magnitude to trade it. And as a result, you will unbundle and rebundle security interests, and you will bring valuable liquidity to securities that don't have it today.
So snail mail to email, made things faster, cheaper, stronger, better. But the form and function of what that communication ultimately brought about in terms of the way we used sort of email to communicate more often in various modalities, et cetera, is really sort of that step function change that changed the way communication happened.
It is.
Okay.
It is, and it's now just the very definition of we use disruptive now just to describe anything or describe basic competition. Disruptive technology is generally technology that's faster, cheaper, and easier by at least 2 orders of magnitude. You can see it with digital photography to film photography. Image is the same, but now you have an explosion of photography and images. The same thing with snail mail to email or any other technology.
Great. So I think that sets the stage here. So why don't you talk us through this slide, Josh, in terms of making sure we have a very clear understanding of what a security token is and what a utility token is.
So how many people own shares in a company? LP interest in a fund? Okay, put an electronic wrapper around it, that's a security token. It's the same content of ownership, only now you're going to be able to transfer it a lot more easily. And we can get into technologically how that happens and all the advantages from it. Utility tokens are they are microcurrency payments. So how many people have had the unfortunate experience of taking their kids to Chuck E. Cheese's? Right? And so you had to go exchange your dollars and you got these tokens, and then you use those tokens to go play whack-a-mole and play the games, and then the kids got all those tickets and they bought all the worthless crap at the Chuck E. Cheese. That's what these protocol tokens essentially are. I'm oversimplifying, but essentially they're a payment mechanism for these decentralized applications. If you want to use software on this decentralized computer called Ethereum or the blockchain, you pay for it. So if you're going to use file storage, use Filecoin. If you're going to have a decentralized Uber, you would use UberCoin. And so they are not security interests, they're just micropayments.
Right. And I think that's a very important distinction. Up until I'd say earlier this year, the majority of what you read about in the news all centered around the explosion of utility tokens. And then obviously the SEC came out at the end of last year saying these are all securities and we're shutting them all down. There's risks obviously associated there, and opportunity, which eventually gave birth to Harbor, which we'll get into. Can you talk about sort of tokenization as it relates to real estate? I just want to make sure we point out where the innovation really can occur and how to think a little bit more creatively about the opportunity at hand.
So let me start at the ending and then come back to the beginning.
Sure.
So the blockchain is just a way to establish ownership. It's a ledger that establishes records. Think of it as like, if you remember the old red ledger books that we used to record things in, one transaction at a time. It's like that, only everyone's operating from one book and it's very secure. As a result of the technology, there is no settlement period. There is no custody or counterparty risk. If you make a trade of ownership, whatever it is, a tokenized security, a tokenized currency, a crypto kitty, if you exchange ownership, you have instantaneous settlement with no counterparty risk. Either payment and trade pass at the same time or they don't pass. You don't need anyone to custody funds. And when you think about it in terms of trading securities, that's amazing. I can trade 24/7, 365 with near instantaneous settlement and no counterparty risk. And so now all of a sudden, if my share in a private REIT, my LP interest in a fund, my share in a private company, I can get matched up in these exchanges that look like and function like exchanges, and buyer and seller can post bid and ask, they can meet each other around the world 24/7, 365, that's revolutionary. That liquidity is value. Today, private securities are illiquid for 3 reasons. The first is buyer and seller can't find each other. And there are exchanges on the blockchain standing up, these electronic exchanges where you can, that have this revolutionary settlement mechanism. Second is that you have to repaper every transaction the most painful way possible. That's not necessary, that's just something that hasn't been attacked. But most importantly, the reason you have no liquidity is that there's always transfer prohibitions on that security. Question is why? And the answer is the issuer has to control for all these complex requirements. If you have an LP interest in a fund, most funds cannot have more than 99 investors. It's different for overseas and in the US, and there's restrictions on liquidity or you blow your tax treatment. If you're a private REIT, you have to have a minimum of 100 investors or you blow your tax treatment. Maximum of 2,000, you gotta go public. Non-US persons have to own less than 50%, et cetera, et cetera, et cetera. So as a result, the only way you can control that private security is to make it go back through the fund manager. So how many people have either been on the buy side or the sell side of a private security and they took a beating on the valuation? So it's an it's a not so hidden secret that there are a lot of fund managers and GPs that make a lot of money buying things back at 40, 50, 60 cents on the dollar compared to the NAV when people are desperate for liquidity. There are people today at JP Morgan and Goldman Sachs who, having spent their time gotten their clients into these highly liquid investments, now spend their time getting them out. And what do? They have to phone, fax, and email. They have to spend a lot of elbow grease to find someone on the other side of the trade. They got to spend 10 to 20 grand to repaper the transaction. At the end of the day, they take a big hit on the valuation, the liquidity discount. If you can tokenize that and you can control all those requirements from the beginning, and you allow those things to trade at the limit of what the securities regulations allow and the depth of the market, you can reduce that illiquidity discount. You can take weeks and months and make it hours or days or even minutes. You can take that illiquidity discount of 30 to 50% and you can make it 10 or 20% and you can unlock tremendous value.
That's great. And we can talk a little bit more about sort of the way tokenization enables new ownership models as well as we go through these slides. Talk a little bit about sort of this, liquidity creates value. Just started to mention that, and we've got a slide here showing, I'd say very holistically what that looks like. But explain why liquidity is so important.
Unless you're a sovereign wealth fund or you're a CalPERS, you need liquidity at some point, and it's usually when you least expect it. You have a change in investment philosophy, you have a change in business circumstance, you have a change in personal circumstance, and all of a sudden you need liquidity, and it becomes difficult. And usually you want liquidity when everyone else wants it as well, and it becomes difficult. And so the public markets function great, but the problem with raising capital publicly is it's laborious, it's expensive, and the ongoing regulatory brain damage is brutal. If you raise money privately, it's fast, cheap, and easy, but there's no liquidity. And if we back up to how the capital markets formed in the first place, if you go back several hundred years, there were 2 magical ingredients that went together: fractional ownership and liquidity. It was a bunch of Dutchmen and a few Englishmen meeting at the corners of Broad and Wall, exchanging these little pieces of paper and coffee houses, and there were shares in these newfangled things called joint stock companies. And today, those private markets still have the fractional ownership, but they don't have the liquidity.
Yeah. And then, this slide here kind of shows what it means. All things being equal, more liquidity you give investors, the lower the return they require.
Correct.
And I think that's important as we think about the breadth and scale of the real estate industry and what tokenization could potentially mean as it relates to value creation.
Put another way, if the illiquidity discount's 30%, you cut it in half, that's 15%. You should get a 15% better price for an asset.
Yeah.
Your $50 million asset, fairly valued, should be worth 65.
And here's an example in real terms is what that illiquidity discount can unlock in terms of value.
Correct.
So talk a little bit more about sort of the ways that this ownership, this new tokenization ownership model can evolve, kind of how we think about, at least creatively, accessing and thinking about real estate.
So I think what it allows you to do, because it's faster, cheaper, and easier, is you can make more micro bets, and then you can micro investments, and then you can reassemble those investments in creative ways. Let me give an example of our first client coming out. It is a property developer who you would all know, has a Class A commercial office building. It's on National Historic Register, single landmark tenant, 20-year triple net lease, unlevered. So very clean, easy to understand investment. It's going in a single asset REIT, and that REIT's going to be tokenized. So what it does is it allows investors to invest at the single asset level in a very easy to understand way. If you think about the hunger for overseas investors for US real estate, the amount of crypto wealth that's out there that's looking for a stable store of value. So people are investing in Bitcoin for a stable store of value. If they think that's stable, they should try US real estate. So you are essentially, instead of public REITs today, which are huge baskets of property, you can now make a bet on a single building. Now imagine a world in which you've tokenized ownership interests in a large or even a decent proportion of the Class A around the New York City area. You can now make a bet on a single building. You can make a bet on the Chrysler Building, on the Empire State Building, on any building on Madison Avenue. Now suppose you then create a fund that owns 10% of the Class A office building in downtown. You essentially have a downtown ETF. You can do the same in Midtown, on the Upper East Side, in the boroughs, in Jersey. The tokenization technology allows you to create levered longs and levered shorts very easily. So I could now go short downtown, long Upper East Side. I could go long Manhattan, short the boroughs. I could go long New York. I could short the Bay Area. I can hedge my risk based off other investments I'm making. I can express my investment thesis at a very micro level or very macro level in a very customized way on the fly at low cost.
Yeah, and we'll talk about sort of that democratization effect a little later in the Q&A. But I do want to move on because I think what's important now is we've started to sort of scratch the surface of sort of what blockchain is and ultimately what it can do through security tokenization. I'd love for you to explain to the audience who you are, what Harbor is, what you're ultimately doing, and how you're taking advantage of all that opportunity you just walked us through to help change how we think about real estate and the financing that you guys can ultimately help effectuate.
Yeah, so I think the best way to talk about it is the origin story of the company, which was David Sachs, who's a longtime entrepreneur in Silicon Valley, was raising a VC fund last year and wanted to tokenize it and realized there was no compliant way to do it because, for instance, on a VC fund or any LP-GP structure, if you lose control of the trading, that's not compliant. You know who all your LPs are. You blow the tax treatment on the distributions because of publicly traded partnership rules. There was just no way to do it. So we thought, aha, there's a business opportunity here. Pulled in the co-founders, myself and the two other co-founders. What Harbor was designed to do is to tokenize traditional private securities. So again, it's not ICOs, it's not CryptoKitties, it's none of that nonsense. And the way we do it, the way we enable it, is to control the compliance, the who, what, and where. We control who the buyer and seller are, things like KYC, AML requirements, accredited investor requirements. We control what the trade is, min-max investor numbers, concentration requirements, holding periods. And then we control the where of compliance. Is it trading in a properly licensed venue, like an exchange or over the counter? So if you can control the who, what, and where of how that security trades, that fund manager, that operator of the REIT can then let that share go to get the maximum liquidity possible.
And when you talk about sort of the business that you're looking to build, how do real estate owner-operators, many of which are sitting in the audience today, how would they think about engaging Harbor, and why, ultimately why?
Yeah, so I think I'd say 75% of our inbound interest is real estate. And a lot of sort of quality folks, names you would know, assets you would know. I mean, I think the tokenization works well where you want to lock up capital and not the investor, where you're sensitive to the cost of capital and where you want to broaden out your investor base. So what's interesting is a lot of the inbound interest has been from people that own trophy assets. Some of them are tourist attractions. And if you own a trophy asset and you're a developer who owns those, you have a couple of choices if you want to raise capital. You can lever up. You may not want to do that. You can sell the entire building, but that's like selling one of your children, and you measure yourself in the industry by the trophy properties you control. Or you can take on a minority investor. You can sell off a piece of a building and maintain control. But the problem is if you have 1 or 2 or 3 minority investors, you've got a real pain in the rear. They're going to squeeze you on valuation. They're going to squeeze you on control provisions. They require constant care and attention. If you could instead say take 10, 20, 40% of a trophy asset, put it in a private REIT, and you could syndicate it to 2,000 people, which we think we can do given the platform and the interest in overseas and crypto investors and US investors at the asset level in US real estate. Now all of a sudden you have a large diversified passive investor base who do what good investors do, which is entrust you with their money and come along for the ride. And you've got a great phrase, democratizing investment. You can broaden that investor base. If I syndicate a $50 million real estate investment to 25 people, it's $2 million each. That's a limited pool of people that are going to write that check. If I syndicate a $50 million investment to 2,000 investors, that's a $25,000 unit investment. That's a huge pool of investors worldwide that can invest. And if you have an electronic platform that can efficiently attract them, onboard them, process them, you can syndicate faster, cheaper, and easier amongst a larger number of investors who then provide increased liquidity downrange.
So I think you brought up an important point. Listen, I think everybody here is looking for blockchain to help them think creatively about financing and gaining liquidity access to their existing real estate portfolios or future real estate portfolios. Silicon Valley and the media is singularly focused right now on the social impact of early stage startups and what their technology innovation really means. How do you sort of view what Harbor's doing in terms of providing that democratization, that access to the sort of the largest wealth creator on earth, which has historically always been real estate? What do you sort of view as that social impact being if this really becomes ubiquitous and you really do sort of unlock the entire retail market to have access to real estate in ways they've never been able to have before?
Yeah, I think on both sides of the trade. So thinking like the people in this room that have to raise capital to go out and build and improve multifamily housing, which is in drastic shortage, to go out and build the infrastructure that enables our economy to run. You have a lower cost of capital that you can raise quicker and easier, you can do a whole lot more. Investors, similarly, if they can get access to these syndicated real estate investments that they don't have access to today, they can build wealth, and they can do it in a way that they can understand. I think what's really interesting is part of the reason real estate is for the first best use case for tokenization, we think. Stable store of value, it's easy to understand. It's tough enough to understand tokenization, and it shouldn't be as scary as it is. But if you can understand the investment, that has a real motive force. If you're an overseas investor looking for a store of stability, real estate you get. If it's lightly levered or unlevered, you can be really confident it's not going to zero. And so when you think of some of the projects that are out there around affordable housing, around infrastructure that we all need, the ability to get lower cost of capital quicker and easier enables us to power that economy forward.
Yeah, I can view a world where if this does become ubiquitous, an ability for someone, I'm from Cincinnati, Ohio. My ability right now to gain access to real estate exposure in Cincinnati is very limited. There's not a lot of publicly traded REITs that have Cincinnati assets, and I'm not purchasing assets myself. But in a world where I can essentially trade in and out of secondary positions, I can make bets on local neighborhoods within Cincinnati and help my community grow with a very clear understanding of where I think value is being created by living in those areas and having intimate understanding of how that economy is changing and shifting, which I think can create a massive amount of opportunity in a whole host of ways.
I think that's exactly right. People can invest in their neighborhoods. So if I back up a little bit, we are a platform plus a protocol. We're a software platform out on the web like any other software platform that allows you to very efficiently onboard investors. We can do KYC ML checks literally while you wait in front of the web browser for most folks in the US and some overseas jurisdictions. So it's a platform that efficiently onboards people raising capital and the investors, and then a protocol, this blockchain presence that controls the secondary trading later that interests your investors in the first place. But we're focused on institutional players initially because it's so important to validate the space and to make everyone comfortable. What we don't want is what happened, I think, with some of the sort of crowdfunding sites early on where you got adverse selection on the deals and everyone got turned off from the space. But I think over time I think is quickly, it starts with blue chip players, it gets validated, and then it comes down to the middle tier. And all of a sudden, people have access. They're doing $5-10 million deals. They're raising capital faster in smaller units. And they're doing it from neighbors, interested folks out in the community. And they're able, to your point, you're able to invest in your community.
And when you think about the implications of sort of what I refer to as on-chain, which sort of reflects the blockchain protocol, I would imagine there's a significant amount of off-chain functionality that you would need to have crop up to help support that type of ubiquity across the markets. What sort of off-chain businesses, opportunities do you think need to proliferate before sort of the on-chain capabilities can really become a standard?
Yeah, so I mean, put another way, your question is, what are all the players out in the industry that need to be there for all this to work really well? And the answer is a lot, but a lot of them are already out there, and the industry's getting built out very quickly. So everything we're doing is, you may hear Ethereum or ERC20. The analogy is an internet standard. Everything's being done to a standard where everyone else can plug and play with common technical standards. Like I can still remember when email first came out on my college campus, you could only email other people on your college campus, so nobody used it. We all left voicemails. It was all about drinking and partying. Tough crowd. But then all of a sudden, I can remember when Gmail and Yahoo, and they all came up, and you could email anyone and exploded because of common technical standards. Same thing's happening today on the Ethereum blockchain. So there are qualified custodians, people that institutions can use to custody their crypto funds or crypto securities. There are exchanges that I mentioned on all these different technologies that can match buyer and seller. There are broker dealers and market makers. I have talked to exchanges, broker dealers, market makers, folks in Singapore, Hong Kong, China, Australia, UK, Switzerland, Canada. This ecosystem is getting built out very quickly in ways that are going to allow everyone to play. I don't want to overstate it. It's nascent, but it's getting built out very quickly.
And there's obviously some external forces that are at play here, especially the regulatory bodies as it relates to sort of ensuring that what you guys are doing is eventually going to be allowed and that they'll be active participants in. What are your conversations like with the SEC and other regulatory bodies? How are you mitigating that risk by forming partnerships and engaging with them?
Yeah, so we have. I had a long sit-down meeting with the SEC this week. It was all very positive. I've talked to not only the SEC, I've talked to FINRA, CFTC, Singapore Monetary Authority, regulator in Gibraltar, representative from the EU, BaFin, the German regulator. And again, don't want to overstate it. These are all everything from sort of our introductory conversations to longer multi-event conversations. The feedback we've all gotten is positive because fundamentally, Harbor's not asking for any changes in the rules. We enforce the rules that are out there, the securities laws and whatever additional contractual restrictions you might have. And I think to take away some of the scariness, because I'm sure everyone's thinking like crypto, oh my God, hacks, you lose everything. It's very different in security tokens. The difference is the token represents the share, the real world asset. It's not the real world asset. If someone hacks an exchange and takes your Bitcoin, it's gone. That token, that cryptocurrency is the asset. You've now, 10 million cryptocurrency gets stolen, you're out 10 million. If someone takes your security token, you're out some hassle. The asset is still there. It's like when you sign the purchase agreement or you sign the investor rights agreement for a private security today, if someone went and stole the paperwork and whited out and put their name in, you haven't lost your investment. What you got to do is then you go to the company and say, no, that guy's not on the cap table, I am, and you sort it out. The actual asset hasn't gone away.
Right. No, I think it's an important distinction because I think security around the stuff is obviously extremely important.
It is.
And so when you just talked about a lot of potential partners, a lot of them were international. How do you think about sort of U.S. Compliance tokens from like a global perspective. How do those two things sort of interact, and how do you sort of view what you're doing here and how that might interface with opportunities in other countries?
So I think, like I said, real estate is the first best use case, is where we see the most interest. Part of the attraction is to be able to onboard investors around the world who have a real, I think, hunger for U.S. real estate. And the thesis is if they're going to spend $2 million on a condo that sits empty, they're going to buy a yielding real estate asset that offers liquidity. If you're a Brazilian professional class that's looking for a store of stability, you'll put in Bitcoin. You'll put it in a piece of the Empire State Building or the piece of the Chrysler Building or the piece of the Ferry Building or what have you. When we launch this summer, we'll be able to support 7 countries in addition to the US for onboarding investors, and we're building that out quickly. We're focused on the rule sets around the world, not just the US. We're starting with US funds, US assets, but the ability to onboard international investors. I'm in talks, particularly with folks in those areas where the investor vetting is harder, so think like Asian countries. And we're focused on major institutional broker dealers and exchanges and others in those countries precisely because they can more easily onboard the investors. They have installed bases of investors now that you can distribute through.
And so this platform that you're building that it sounds like you're going to launch at the end of the summer, again, you talked about some clients who are going to be launching on the protocol. What can you just explain very quickly as a user, what's the experience like?
Yeah, so let me I'll walk you briefly through the life cycle. So it'll start off with, there's a website, going back to the example we used before, www.awesomebuilding.com, right? And it'll have a little bit about the investment opportunity, a little bit about the operator, a little bit about the building, some sexy curbside shots because this is a historic building. It'll say, if you're interested in investing, click here. You click on the button, it takes you to Harbor, you open up your account. It'll feel like opening up an account at Schwab or at Square or any other sort of financial company. Name, address, phone number, date of birth, social, a few other bits of information. You will upload an image of your driver's license if you're in the US, passport if you're abroad. It's just a couple of screens of info. You do that, we do the KYC AML in real time for folks. We get an 85% match rate in the US. We use the same vendor on the back end that PayPal uses. We get a match on the KYC AML, we take you to the credit investor status. You say, hey, I want to prove my income or assets. You upload the documents right there, K1, W2, bank statement, whatever you want to use. You can instead say, hey, I want to have my broker-dealer, my CPA, or my attorney attest to my accredited investor status or my QP status. And what you do is you just put in their name and email address. We send an email with a form letter to that person. They sign electronically right there on their computer. It comes back to us. Then all this gets verified by a vendor of licensed attorneys. So everything is double checked. That takes 1 to 3 days offline. You then come back to the Harbor website. You see all the documents right there on the website. Offering memorandum, environmental review, material leases, what have you. You sign right there on the website. Then you go to a purchase order flow. It's like Amazon.com before these private securities. $50 million raise, private REIT, 2,000 investors. That's a $25,000 unit investment. I want 4 shares, 4 security tokens. 100 grand. You want to pay in dollars? Here's your wiring instructions. You want to pay in cryptocurrency, Bitcoin or Ether? We work with a currency trader. You get a spot price. You can convert right there. You pay in your cryptocurrency, and the issuer, person raising the funds, gets dollars in their bank account. We're matching up wires to signed agreements. We put together a tentative cap table. The issuer says, yes, these are my investors. We close, notifying the investors their investment's been accepted. You're done. It's essentially, at that point, everything at this point has been the same experience you have today, only on a modern, high-tech software platform that's very efficient and is good, clean user experience. Then at this point, this is where it becomes new. This is the crypto part. We create a wallet with a qualified custodian. We create this security token. If tokens scare you, ignore it. It's locked down. If you never want liquidity, you never want to deal with crypto, you still have the same investment, you had a nice modern experience, you're done. If you ever want to trade, if you ever want liquidity, now you're in the crypto world, the blockchain world, you have this security token, you can go trade it. You go on to these qualified exchanges around the world that some exist now, some are getting quickly stood up, and you can go trade 24/7, 365 with no counterparty risk and near instantaneous settlement. That's the revolutionary part.
Yeah.
So it's a platform that offers you a much better, more efficient experience with a protocol, blockchain experience that's revolutionary.
No, it's incredible. I mean, when you think about the implications there, obviously this seems like a pretty incredible space to be in, and being a first mover, I think you're well positioned to capture a significant portion of the market. Is this a winner-take-all market? How do you think about the evolution of the space and Harbor's place in it?
It's not winner-take-all. So, I mean, these are TAMs, total addressable markets, measured in the tens of trillions of dollars. I mean, if you take commercial U.S. real estate in the U.S., was it 13 trillion, 17 trillion?
17, yeah.
$17 trillion, that'll all get tokenized. If it takes 100 years, it's $170 billion a year. No one's gonna own all of that, and that's one asset class in the U.S. And it's not just real estate. You got real estate worldwide. You have private companies, you have funds, you've got modern art's an interesting one to talk about conceptually, because that doesn't get securitized today, and I think it will. And so no one's going to own it all. I think it's going to look a lot like investment banking, even though this is technology. Goldman Sachs doesn't own it all. Goldman Sachs plus JP Morgan plus Morgan Stanley don't own it all. There's going to be a ton of players, and I think there's room for everybody. The Harbor's focused on not owning anything end to end. We're not an exchange, we don't compete with them. We're not an investment banker, we don't compete with them. We're not a broker dealer, we don't compete with them. We're a platform. We're like Salesforce.com, which didn't get rid of salespeople, enabled them. I think what's interesting to think about, which may be interesting for this audience, is what's the role of a commercial broker in which people, when they want to raise capital on a building, don't just sell the whole building to one owner, and the commercial real estate broker takes half a point to a point and a half. Instead, they're trying to do this fundraising. What's the role of a commercial real estate broker? I think it's a much more expanded market for you guys, both on the initial capital raise and on the secondary markets, and I'll tell you why. Because you folks have the granular knowledge others don't. On a national stock exchange, that's a very centralized set of knowledge. Real estate is very different block to block. There's a ton of gotchas around leases and environmental reviews, parking, a whole bunch of stuff. That granular knowledge becomes more valuable, not less. It becomes more valuable on the initial raise, because today you're still going to have not only that money, but you're going to have a bigger piece of the pie that's available to you to facilitate these capital raises that's tokenized. Still got to do the due diligence. You still got to get appraisals. So in essence, you're performing investment banking functions at greater value add. So private raises today increase, bigger pie for you. And then secondary markets, which don't exist today, you now can play a valuable role. Information is key to secondary markets. Who has that information to enable the trades? It's the commercial real estate brokers.
Right. And I'd say before we move on to Q&A, because I do want the audience, especially the naysayers, to pepper you with some questions. What would you recommend to the real estate players in the room today? How would you recommend them getting involved, whether they have a sophisticated view or not about the evolution of this space? What's your advice?
Yeah, so I was talking to one property owner you would know, ton of marquee assets, had this catalog, all these beautiful, some of them historical office buildings and marketplaces and whatnot. So they hand me this catalog, $4 billion of real estate. They're like, how would you raise $500 million? And the answer is I wouldn't. I don't know that the market could support that. I certainly wouldn't want to bet my business on it at once. We are at the stage of internet 95, 96. What I would do is I would experiment with it. What you don't want to do is be the retailer that ignored the internet in 96. But what you don't want to do is go all in as this builds out. What you want to do is you want to take a building, a fund, you want to experiment with it. At the end of the day, if it all goes wrong, you're out some hassle and some cost, but there's nothing catastrophic that can happen. Now's the time to experiment and to do it on a level at which you can start learning the lessons as the market expands, as the investor pool expands, as the ecosystems of exchanges and market makers expand, you expand your presence, but learn the lessons now.
Yeah, I would imagine that in the room, whether you have a board or a portion of LPs, they're going to be asking you how blockchain's affecting the business, and if you don't have a thoughtful answer, I think you might be in trouble as this industry continues to evolve. So with that, we'd love to open it up to Q&A.